Good morning, ladies and gentlemen. I'm Kanda. It's my absolute pleasure to have this second opportunity to speak at this conference today. And I'm going to be speaking on STR profitability, what moves the needle. So it's a real honor to be able to start off this summit. Obviously, the VITA either expected me to be able to set the tone with a positive speech, or they want to get me out of the way early, so one or the other. All right, so I'm going to be touching on these topics today. Firstly, I'll give a bit of a summary about myself and my company, as well as a tourism market update. And then the meat of my talk will be on what moves the needle for STRs, followed by a little teaser of my breakout room, a few company updates, and then Q&A. Okay, so just to recap, I was born in Australia, and I got a Japanese mother. I got a law degree and a finance degree, and I moved to Japan in 2007, splitting half my time between Osaka and Kyoto. I got 7 years experience in financial analysis and strategy, and I had a lot of belief in Japan's potential as a tourist destination, and founded Shiki Properties in 2014 to ride this wave. I really feel strongly about protecting historical structures, as well as promoting healthy, positive immigration and driving growth in Japan's tourist sector, as well as the wider economy. Our company has a strong focus in Kyoto, but we're also having a look at some emerging regional areas. Okay, so just a quick overview of our company. We're Shiki Group. We got offices in Kyoto and recently in Nagano. We've got 38 staff, and at the moment we're managing a portfolio of about 50 STR and monthly rentals, as well as 3 boutique hotels, one of which we just picked up last week and we're preparing at the moment. So our company has 2 main divisions. We have Shiki Properties, which is the accommodation management division, and then we have Shiki Real Estate, which is the brokerage. So the management part is the core part of our business, and in our brokerage, we mainly broker accommodation facilities, STRs, as well as hotels. Okay, so just wanted to provide a bit of a market update. Most people will be familiar that tourism is going pretty well here, and the brown line at the top is the numbers for 2025. So we've had general progression upwards every year, and this year is looking to break all records. And the JTB is forecasting that we're going to clear 40 million tourists for the first time this year, which would be 9% year-on-year growth. I actually think we're going to hit about 43 million, and that's going to be 16% year-on-year growth. So the government target is 60 million. So I've just tried to illustrate what that might look like if we hit that target. So 43 million this year, perhaps we can go to 48 next year, 53, and under this kind of progression, we would hit the 60 million in about 2029. I've got a feeling it might be a little bit slower than this. So the word on the street is that next year, the tours are booking a little bit more slowly. So it's quite possible we're going to have flat or even small. Okay.
Oh, you got.
Yeah, I got. Or even just a small increase next year, but we're marching higher. And just for comparative purposes, Italy has 71 tourists a year. Spain has 94, and France has 100 million. Okay, so wanted to provide a bit of a longer-term outlook on the tourism industry. So at the moment, we're having a bit of a growth period. It's ongoing. And then particularly in Kansai, we've had the Expo this year, as well as the casino coming up in 2029. So there's a lot of tailwinds for Kansai. And then moving on to 2030 and beyond, we're probably going to have a shift from more from volume increases towards yield increases. So things like premium properties, culture, wellness, nature, and long stay work travel. And there's an expectation that the tourist spend will double by 2035. And after that point in time, we're going to see a very mature market, and the focus will move towards managing growth, crowd control, sustainability, and the like. This obviously brings some structural challenges, and the first one is that there's going to be a huge labor shortage. The expectation is that this is going to be a shortage of 500,000 by 2030, and this will be counterbalanced by automation, professional management, and AI to an extent. So what does this mean for STRs? And I feel like this means that profitability will hinge less on pure occupancy and more on factors that can increase RevPAR. And these include things like design, features, professional management. The increase in RevPAR is aligned with the government's goals and to move Japan from a pure numbers game to a more mature tourism market. And I'm going to be talking about some of these points in my speech today. Okay, so the weak yen is continuing to drive the demand into Japan. And what we've seen is that the hotel ADRs and the RevPAR are up substantially year on year. So pleasingly, our own ADR and RevPAR are up even more than the averages. And
sorry, what's a RevPAR?
Yes, sorry. So RevPAR is ADR times occupancy. And ADR is average daily revenue. So it's your average rate times the occupancy gives you the RevPAR.
Nah.
Okay, and the big one to note there is Osaka occupancy is off the charts, 52.5% increase year on year driven by the expo.
Yeah.
And last point down below there is that foreign residents are up substantially. We're up to 3.8 million in Japan now, which is 358,000 increase last year. And there's about 1,000 new residents a day coming in, and the suggested target is about 1,500. Okay, so a little market snapshot here. For Kyoto short-term rentals, the average ADR is 26.6 thousand, and the average occupancy is 65%. So comparing that to our own numbers, our average ADR is about 35,000, and our occupancy is slightly higher at 67%. Some of that is capped by 180-day rentals, which pushes the occupancy down a little. For Osaka STRs, the market average is 18.3 thousand, and the average occupancy is 58,000. For us, our Osaka portfolio averages ADR of 20,000 and 64% occupancy. There's been a lot of interest in the Osaka market of late. It's a more reasonably priced market, although there are some licensing changes incoming. Some of you may have heard about that. So I'll be touching on that in my breakout session about what kind of implications that may have on the Osaka market. But a lot of projects have been cancelled or postponed, and we feel like that is going to give rate support into next year. All right, so this is the main part of my speech, what moves the needle for STRs, and I think it's the factors below: location, size, capacity, grade, features, and professional management. So I'm going to break these down one by one. So first up is location. So just to recap, the Kyoto STR market average ADR is 26.6 thousand, and the average occupancy is 65%. Multiply these two together and you get the RevPAR of 17.3 thousand. So as I was putting this presentation together, I pulled a lot of market data, trying to justify my thoughts. And then I had a look at our own data, and actually our own data was quite different to the market data. So I completely scrapped the market data. I went with our own data, and I think it's a little bit more interesting. You guys can see the other stuff online. But next thing, I just apologize for my crude scribble there, but that green line, inside the green line there, is what I consider to be central Kyoto. So when I look at our data, inside that green line, we have an average ADR of 45.7 thousand. and our occupancy is 70%. This gives a RevPAR of 32,000 yen, which compares quite nicely to the market average, as you can see. So most interestingly is that when I look at the yield for these properties on a cash-on-cash basis, the average is 10.5% inside that green line. So the next zone that I want to have a look at is between the green line and the crudely scribbled red line. This zone is averaging 33.8 thousand ADR, and pleasingly, same occupancy, 70%. This gives a RevPAR of 23.5 thousand, which is 26% less than inside of the green line. And the key point here is that the yield has dropped to 8.9%. So what does that mean? It means that central properties are going to yield higher if you can afford them. So what lies outside of the red line? Well, I don't really have too much data on that because we generally don't accept those properties. And the reason is that I feel like the economics are just going to fall away. Your ADR is going to fall, your occupancy is going to fall. It's a little bit difficult to manage those kinds of properties and get a good performance for a management company. Also, the operational cost goes through the roof. So it's really a difficult dynamic to operate. In saying that, we do have some monthly rentals outside the red line. I think that is something that's an opportunity. And the red line does seem to creep slowly outward as we get an increase in tourism and over time. Okay. All right, next point I want to touch on is size. So if we have a look at my graph there, I've broken it down into subsections. So between 1 and 60 square meter properties have an average ADR of about 40,000 yen and average RevPAR of about 30,000. And interestingly, the red line there shows the yield. The yield is on average about 9%. So moving on to the next subsection, we have 61 to 80 square meter properties. You can see that the ADR doesn't move that much. It's slightly higher, RevPAR slightly higher, yield slightly higher. We're coming in at about 9.1%. But it's the next move that's particularly to note, which is 81 to 100 square meters. So here we have a solid increase in ADR coming up to about 50,000, RevPAR following suit, but the yields moved substantially higher. So we're up to about 10.5% there for that size of property. And finally, above 101 square meters, we can see a huge lift in ADR and RevPAR, although I'd like to note that this data set is a little bit warped. Those properties are actually higher quality, which is warping the numbers a little bit. So I'd be a little bit careful of taking something on isolation. I need a little bit of a blended analysis. But importantly, it's quite visible that we have a big uplift there. So yield for the larger properties is coming in at 11%. What's the takeaway? Larger, it's higher yield. And I think the sweet spot's clearly between the 81 and 130 square meters. So in saying that, I have a contrary example here. So this is a new property that we have called 834 Mibu. And as you can see from the floor plan, this one is petite, 32 square meters. But these owners have put in a lot of effort on the design as well as marketing. So they've been featured in a number of magazines. They've got their own website. So, in general, larger properties, larger yield, but you can buck the trend by focusing on some other factors. Okay, so next one, I'm going to move on to guest capacity. So we can see here, up to 5 guests has an ADR of 30,000 and a RevPAR of 20,000. And for these properties, the yield is a bit under 9%. Next category is the 6 to 8 person category. We can see a huge jump in ADR here, going from 30 to 50,000. And the RevPAR is solidly higher as well. And most notably, the yield has jumped substantially. So we're now up to 11% for this size of property. And lastly, 9 person. I can probably remove that plus because 9 is the maximum allowed in Kyoto, but we can see an even higher ADR, a higher RevPAR, and a higher yield. So what is the takeaway? Bigger is better, 6 plus optimal. Although I would say to have 6 guests, you need to have 2 toilets by law. You also need substantial floor space. It's quite difficult to secure these properties, and obviously it costs a little more money. And here's an example of one of these properties. It's a new one for us called Korju. This property has 4 bedrooms and a capacity of 8 people. And it's really banging it out of the park. Very impressive ADR, great occupancy, very pleasing result. Okay, so next factor I'd like to talk about is grade. Our company splits the properties up into 3 grades. So we have standard, premium, and then luxury. And I like to think of it as 3, 4, and 5 star approximately. So firstly, I'm going to start off with the standard properties. They have an average ADR of maybe 27,000, and the RevPAR is coming in at about 20, and the yield is about 8.3%. For the premium category, you can notice a substantial increase in ADR coming in at about 40-something thousand, and RevPAR is getting close to 30,000. But most importantly, the yield is now up at 10.5%. And then for luxury, ADR and RevPAR through the roof, but the yields actually come down. So what is the takeaway? I think the premium properties yield the best, and that's the priority for us as a management company. And this is an example of a premium property. It's called Seidan. You can see a little bit more space here, and very nice renovation, quite beautiful style. Okay, moving on. So next factor, features and amenities. I think you can see in the States with the short-term rentals there, people seem to be going gangbusters with the features and everything. Not going to fit a pickleball court in Kyoto, but we can fit a few other items. So I've focused on a few there. First one is rotenburo, or jacuzzi, some kind of nicer bath. It's very difficult to quantify these figures, so these are just suggestions that I've found from the market, but the suggestion is that for a hot tub, you should be able to get an ADR boost of 15 to 35% and an occupancy lift of 4 to 10%. And this translates to an increase in RevPAR of 20 to 40%. So I was saying it's difficult to quantify, but actually we have a hotel where we have 8 rooms with no jacuzzi and 2 rooms with a jacuzzi. So the numbers for that hotel actually show a 62% increase in ADR. So very illustrative. So the next one is sauna. The suggestion is that sauna will give you a 5 to 15% increase in ADR, a 2 to 5% increase in occupancy, which translates to an 8 to 18% increase in RevPAR. We actually don't have any saunas at the moment, but we're working to install a few. So we're putting a few into our new hotel and also a property in Toyama that we're working on. And I was going to go through these in the breakout room and show the designs and things like that. So next factor would be garden, big living room, full kitchen. A few examples in these photos. This will give you a plus 5 to 10% ADR lift, 3 to 6 on the occupancy, and possibly something like an 8 to 15 on the RevPAR. And lastly, some other potential amenities would include things like a barbecue, a pool, fire pit, gym, SUP, kayak, a boat, or even I've seen a car before. I believe none of these are not so tailored specific, but they can be sufficient. And this is our hotel wiki. It could be gift for brick. Okay, so last one, professional management. So I do apologize for spitting my own horn. But professional management should give you a revenue alert. So you should be able to lift revenue by something around 5-58% on the ADR, depending on the performance of the management company. And occupancy should be up 5 to 10%. That should take you from an average occupancy of the 65% we were mentioning before, more towards like a 68 to 72%. And this translates to a RevPAR increase of 12 to 22%. So why are you going to get revenue increases? Well, things like direct bookings, optimal pricing strategy, more marketing, more sales channels, and also relationships with direct agents. Things like that should give you revenue enhancements. This is going to give you a 0.8 to a 1.4 million yen increase per year for your average property. And on the right, I've tried to display that on the graph, taking the middle point there at 1.1 million. So moving on to cost savings, you should be able to get a 0.3 to 0.5 million a year cost saving on tools. So that would include things like channel manager, bulk ops, pricing software, things like that. You get some cost savings. Also, there will be some time cost savings if you are not self-managing the property. So this calculation here, I've taken 2,000 yen an hour and the amount of time you'll save on communication and things like that. So putting all of that together, roughly, you'll save about 0.7 million yen a year. And then counterbalance with that, of course, is management costs. It's going to be 15 to 25% of gross revenue, depending on the management company and the property. So that on an average property, that would be 1.34 million a year. So overall, where do you sit? You actually end up with a plus 0.26 to 0.86 million gain per year using a professional management company, approximately $500,000 on average. And a new property that we recently hosted Mr. Nicholas Pettis at. I don't know if anyone saw that video, but very nice to have him in Kyoto. Okay, so I would encourage everyone to invest smart and know what moves the needle on STRs. So a central location, size hitting a sweet spot of between 81 to 130 square meters, going for 6+ guests, at a premium grade, add a few amenities in there, and consider professional management. So if you can hit as many of these factors as possible, it's just going to compound your gains in RevPAR, yield, and long-term asset value. So just for example, if you wanted to hit all of these in Kyoto, you're probably looking at about 85 to 100 million yen. Anyone wants to put this strategy in play, please contact us. We'll try and execute that for you. And if you have a lower budget, we'll try and source the highest performing property we can with your budget. So we can offer brokerage, design consulting, licensing, and of course, full management. So in the breakout room, just going to go through a few of our new larger properties where we're featuring a bunch of those amenities that I just referred to. So I'll show some designs there and talk about that. And I'll also drill down a little bit more on the Osaka market. So as I mentioned before, Osaka market has a lower investment point than Kyoto and very strong outperformance this year due to the expo. But I feel that that's going to fall away next year. I think ADRs will retreat. I think acquisition prices will retreat. There may be some opportunities. And then that is counterbalanced by some potential regulatory changes. So I'll be chatting about that. And here's an Osaka property that we manage. Okay, a couple of other updates. So our Nagano office is underway. In Nagano, we're offering both brokerage and management, both of STRs and vacation homes. And we're onboarding several management properties for the upcoming season. We're also preparing to list one ski lodge for sale, and the first cut of the numbers are eye-watering. If anybody's interested in that kind of property, please follow us on our Instagram or also if you go to the Shiki Real Estate website, you can sign up for our newsletter. The newsletter is where we'll send that information out first. So if you're interested to have a look at it, please sign up. We've got some interesting rural projects we're working on in Toyama. We have 5 houses in this place called Uchikawa. That's ongoing. I've also got a hotel I put an offer out on in Kyoto, a few others in the works. If you're interested in this kind of stuff, you can follow me on LinkedIn, and maybe there'll be an opportunity to co-invest on some of those projects. And I'd like to thank you very much for this opportunity.